Hi, good evening, everyone. Okay, so in the meantime, we'll just do a brief recap of whatever we did in yesterday's lecture, and then we'll start with session 4. So I'll just start sharing my screen. So in yesterday's lecture, that's session 3, we looked at the project cost components. What are the major components? So it could be your non-current assets, your land and civil construction, plant and machinery, or other fixed assets. And then you could have your other expenses. We looked at contingencies. We looked at how through EPC contracts, a lot of companies can bring down the contingency and even negotiate with the lenders and bring down the interest rates. Finally, what you get is your total project cost, which is a combination of all these elements. Then we looked at the factors which are to be considered while, let's say, you're implementing a project. So you'll have to look at the market factors, you'll have to look at technical factors, economic factors. You'll also have to look at what will be your financial projections. So a lot of assumptions have to go into calculating as far as calculation of financials are concerned. You'll have to look at what will be your gestation period. So depending upon what's the time frame that will be required for the infrastructure to be ready, you'll get an approximate idea for the gestation period, for how long will the project continue. That's the life of the project. And we said that that will be the lowest of these three, which is the physical life, the market life, and the techno-efficient life. And again, terminal value will play an important role in calculating the cash flows. Then we looked at sensitivity analysis. While capturing risk, companies look at sensitivity analysis, they do scenario analysis, they look at probabilities, and try and capture the risk impact. Then we looked at the cash flows. So in implementing a project, we're not concerned with profits, we are concerned with actual cash that is coming in and going out. So we look at cash flows. We looked at what is sunk cost and allocated cost, and these costs, we said that these costs are the costs which are to be ignored. Only incremental cost is to be considered. Sunk cost, which is a cost which has already been incurred, should be ignored. Allocated cost is an existing cost, which an accountant will typically, let's say you implement one more project, the accountant will allocate the cost. So we are not concerned with that, because again, there's no incremental cost that is being incurred because of the new project. So again, these two costs are to be ignored. We looked at why things are to be done on a post-tax basis, because different sources of financing tax at different rates. So if you look at debt, you have to pay interest. On interest, you get some tax benefit, but dividends are paid from profit after tax. So one is paid on a pre-tax basis, one is on a post-tax basis. The base is not the same. So we do everything on a post-tax basis. And finally, what we look at is your cash flow from operating activities. So investment and financing decision is separate. Then we started with the two basic techniques in investment decision, which is your payback period and discounted payback period. And the main issue or the limitation of the payback period is that you don't look at, let's say, the time value of money and the cash flows which arise after the payback period. Plus, it's very arbitrary, because let's say the top management could decide that they will accept only those projects where the payback period is less than 5 years. But you could have an excellent project, but the payback period for that project could be 6 years, and you might end up rejecting it because it doesn't fill the mandate of the top management. Discounted payback period, it's slightly better than a payback period, because you're capturing time value of money, but then again, you ignore the concept of whatever cash flows arise after the payback period. So we looked at these two techniques. So today's session, we'll continue with the remaining techniques, and we'll also look at the concept of cost of capital. So let's look at the first one, which is net present value. Anyone who can tell me what do you mean by net present value? How do you calculate that? Yeah, the short form is NPV. So how do you calculate NPV, net present value? Anyone? Okay, get the present value of the cash inflows, subtract the initial investment. Due to inflation, value of money decreases, so we calculate present value of money. Fine. So if you look at net present value, the name itself tells you what you're supposed to do. It says net present value. So how do you calculate it? You will calculate your present value of cash inflows, and from this you will deduct the present value of cash outflows. So let's say I've got a project which has a life of, let's say, 5 years. So 1, 2, 3, 4, 5. I'm generating some cash flow. So let's say 10, 20, 30, 40, 50. And I've spent, let's say, 35 over here. 35 lakhs, 35 crores, whatever you feel like assuming. Now, I can't compare these numbers directly with 35 because of the concept of time value of money. So what I need to do is I first have to convert these inflows and calculate the present value of these inflows. So to convert and calculate the present value of inflows, what I need is the discounting rate or my cost of capital. So let's say that's given in the question and they tell you that your cost of capital is 10%. So I'll calculate present value of 10, 20, 30, 40, and 50 using this 10% and calculate the present value of my cash inflows. So let's assume that I calculate the present value of cash inflows at 10%. And let's say I get a hypothetical number of, let's say, 50. So I've calculated the present value of all these 5 numbers and the present value comes to 50. Now, amount of money that I'm spending today is 35. So that's my present value of cash outflow, which is 35. So how do I calculate my NPV? NPV is nothing but present value of cash inflow minus present value of cash outflow. I get my net present value, which is 15. So I'm saying that as of today, I'm spending 35. As of today, I'm getting 50 because of this project, which means as of today, I'm able to increase the wealth of the shareholders and the people who've invested in the company by 15. So that's net present value. Any doubt with the concept before we, let's say, look at a sum on Excel or something? So if you look at, let's say, this concept of NPV, I mean, it's far more superior to time value of money. I mean, the payback period, because number one, it considers time value of money because we're calculating present value, which we're ignoring in the payback period. So that's a big advantage. You consider time value of money. Plus over here, you capture all your cash inflows and outflows. So it's not that I ignore my cash flows after the payback period. So let's say my payback period, let's assume hypothetically that my payback period is 2.5 years, which means I'll be ignoring some amount of cash flows that arise in the 3rd year. I'll be ignoring the cash flows of the 4th year and the 5th year in the payback period. But in NPV, I capture all my cash flows. So cash flows and outflows of the entire life are considered. Time value is considered. So it's far more better compared to the payback period. And again, this is one of the most prominent techniques that are used by the corporates when they're implementing a project. So let's look at numerical on NPV. So let's look at the first one. So what is NPV? NPV is nothing but present value of cash inflow minus present value of cash outflow. Let's look at the first example. So here I've got a project which has a life of 5 years. And from the 1st year to the 5th year, I'm getting constant cash inflows. So it's a constant cash inflow, which means it's an annuity. So I'm getting 30 each year in the 1st year, 2nd year, 3rd, 4th, and 5th. And initial investment is 100. So I'm investing 100. Next 5 years, what I get is 30. So if I want to calculate my NPV, NPV is nothing but present value of cash inflows minus present value of cash outflow. So first, let's look at present value of cash outflow because that's easy. So what is my present value of cash outflow? I'm spending 100 today. So that's already in terms of present value. So I already know what's my present value of cash outflow. So that's 100. So I already know what's my present value of cash outflow. Now I want to calculate the present value of these 5 numbers. Now this is an annuity, so I can easily calculate the present value of an annuity by using the formula. So I'll just write equal to present value and I'll take the rate. So let's say the rate is given in the question as 20%. So I take that as 20%. N per, that is number of periods. This is happening for the next 5 years. So I'll take my N per as 5, number of periods as 5. And what is my payment? My payment is 30 because it's an annuity. So I can use the concept of PMT, which is 30. So I'm getting 30 each year for the next 5 years. And I want to calculate the present value of that. So if I calculate the present value, then it comes to 89.72. So my present value of inflows is 89.72. I'm spending 100 today. So on a net basis, what am I generating? In fact, my wealth is going down by 10.28. So that's your NPV. Any doubt with the calculation of NPV, which is negative 10.28? Okay. Now, if your NPV is negative or if your NPV is positive, then what do you do? As a thumb rule, if NPV is positive, you will accept the project. If NPV is negative, you will reject the project. Because if NPV is negative, you're telling me that you have reduced the wealth for the company. So why would I accept the project? By accepting the project, the value of the company will go down by 10.28. So I'll not accept the project. But let's say if instead of minus 10.28, this was plus 10.28, I'm saying I'm increasing the value of the company by 10.28. So I'll accept the project. Yeah, you can use it for any contract. So you can use it for the fixed price projects also. Yeah, definitely. Now, this approach that I've given you is all right from an exam perspective, from a classroom perspective. It says that accept the project if NPV is positive, reject the project when the NPV is negative. But again, I mean, in the industry, let's say if I take this example, same example, and I say that, okay, you're spending 100 today, and let's say the present value is not 89.72, let's say it is 101. So present value of inflow is 101, present value of outflow is 100. So what will be my NPV? My NPV will be positive 1. Let's say you are running this company. You have invested 100 crores today. All these cash flows, when you discount it, you're getting a present value of 101 crore. NPV is 1 crore. What will be your decision? Accept the project, reject the project? What is to be done? Accept. Okay, I've got an answer saying accept the project. Fine. Any other answer? Depends on the strategy. So Alok, could you just be a bit more elaborate? What's your strategy? Okay, Vikas is saying depends upon whether the expected margin is greater than 1 or not. Now, again, I mean, the management hasn't decided a cutoff, which is like in a payback period where they say, okay, we'll accept only those projects where, let's say, the cutoff is more than 2 years or 3 years. NPV, it just tells you that you're increasing the value of the company by 1 crore. So when I do this evaluation, the management knows that if they accept the project, they will increase the value of the company by 1 crore. So the question is, should you accept the project? And let's assume it's a real life situation. You're running this company, you're heading this company. Should you accept it? Yep. Anyone? Okay. Theoretically, it's absolute reject considering the 1 crore profit is low than 20% capital. Now, again, after taking into account 20%, I'm saying that I'm still generating 1 crore over and above my investment. So I've taken 20% as my cost of capital. And after taking 20% cost of capital, I'm still increasing the wealth and the value of the company by 1 crore. So should I still accept it or reject it? In a real life situation, accept it, fine. Now again, from an exam point of view, what you do is please say that you will accept it. So don't just say that no, you will not accept it. From a classroom perspective, exam perspective, if the NPV is positive, and even if the answer is 0.00001, please say you'll accept the project. And let's understand why practically it may not work when you're running a company. Practically, I will not accept this project. I'll reject the project if I'm running this company. The reason is all these are forecasted numbers. Future is uncertain. So sitting today in the 0th year, I project that for the next 5 years, I'll get cash flows of 30. And there's no guarantee or certainty that I'll get cash flows worth 30. So there's a lot of risk involved when I tell you that I'll be generating or increasing the value by 1 crore over the next 5 years, assuming these cash flows. So practically what happens in real life is NPV should be at least 20 to 25% of your initial investment. So let's say if your initial investment is 100 crores, you come and tell me that I'm implementing a project and you calculate your NPV. And if your NPV is, let's say, less than 20, let's say you come and tell me NPV is 10 crores. I'm not even going to look at your project because I'm going to tell you, these are all forecasted numbers. Can you assure me that we'll get these cash flows for the next 5 years? The answer would be no. So because there's no guarantee or certainty, and these numbers could go up and down, therefore you want that buffer or cushion. So you will not take this project if you have an NPV of just like 1 crore, 2 crore, 5 or 10 crores. You want to play safe, and therefore you will say, okay, I will accept this project only if my NPV is 20, 25, 30. Otherwise, there's too much of risk. Let's reject it. Let's not waste time and evaluate this project. So theoretically, even if I get 1 paise, I will accept it. Practically, your NPV should be at least 20 to 25% of your initial investment so that you can go ahead and accept the project. Yeah. Any questions on this? Okay. Now, let's say I don't want to use the concept of or the formula of present value of inflows and then deduct the outflows. Okay, question is 20 to 25% means NPV should be greater than 20. Yep. So when I'm saying that your NPV should be at least 20 to 25% of your initial investment. So what's your initial investment? Initial investment is 100. So if my initial investment is 100, this number, that is NPV, that is present value of inflow minus present value of outflow, should be at least 20 and above. So if it's 20, 21, 22, it's then that the board and the top management will sit together and then they'll call a meeting and then they'll go through the financials, they'll look at the assumptions. But someone comes and tells me, I will take this project where the NPV is 4 crores. I mean, the top management say, please don't even put it before the board. The board will straight away reject it because we are not too sure whether this 4 crores will come in at the end of the 5th year or not. So there's too much of risk involved. Let's reject it. We will not accept it. Okay. Now, let's say I don't want to use this concept of present value of inflow and then deduct the present value of outflow like I did it over here for this question in the first part. So this one, I calculated present value of inflows, then present value of outflows, then NPV. Can I directly calculate the NPV? Yes, Excel helps me in that. So Excel tells you or gives you a formula of NPV. You can do that. So I've just copy pasted the same numbers and I can directly calculate my NPV. So what I'll do is I'll write equal to NPV and then insert the bracket. Once I insert the bracket, I get these prompts which tell me what is to be inserted. First thing is the rate. So what is my rate? My rate is 20%. Then it says insert the values. Which values? Values that you're getting from the first year till the last year. So whatever values you're getting from the first year till the last year, these values are to be inserted. So what are the values that I'm getting? I'm getting 30, 30, 30, which is nothing but C22 till C26. So I've written C22 to C26. So this, and then I close my bracket. So if I look at these numbers, which is C28, C22 to C26, what will happen? This will give me the present value of all this. So I'll get the present value of the money that is coming in from the first year to the fifth year. So indirectly, the bracket is telling me what is my present value of cash inflows, which in the earlier part, I was calculating it separately. But to calculate NPV, I also need to subtract the present value of cash outflows. Now, what is my present value of cash outflows? My present value of cash outflow over here is 100. So I've already written it as minus 100. So I'll just add this number of 100. So if I add the number of 100, what I get is 10.28. So my NPV is still minus 10.28, which I was getting earlier also. So even over here, I was getting an answer of 10.28, and I'm getting the same answer over there. So you can directly do it. You don't have to waste time first calculating the present value of cash inflows, then writing present value of cash outflows, and then NPV. Just directly use the formula of NPV. Okay, got a question. Why don't we consider minus 100 within the formula and add it separately? Now, I have written minus 100 over here to show that it is an outflow. Now, how do you calculate NPV? NPV is nothing but present value of inflow minus present value of outflow. So you're saying that whatever money is going out, that has to be shown with a negative sign. So if I look at this formula, it says rate, then the values. So this will give me the present value of all these 5 numbers. Okay, fine. But then I also need to deduct the present value of cash outflow. Now, if I don't write minus 100 over here, and if I just take 100 over here and I write plus 100, then what will happen? It will add the present value of these 5 numbers plus this 100. But this is an outflow for me, so I'll have to deduct it. So that's the reason why I've just added that number. If you want, then what you'll have to do is you'll have to take this as a positive number, and then over here you can write minus. You'll get the same answer. So the way you are comfortable. Now, if I write a positive number over here, then somebody would say, no, all these are inflows. That is the reason why I didn't do that. I just write a minus over here to indicate that it's an outflow. And if it's already an outflow, then I will not take a negative sign over here, because then again, minus and minus will again make it a positive number. So either you take a minus over here and then write a plus sign over here, or vice versa. You take a plus sign over here and write a minus over here. So again, the way you're comfortable, you do it, but then you have to reduce the cash outflows. Yep. Any questions on this? Anyone? Okay. Got a question. What if there are outflows in the middle? Absolutely fine. So let's say I've got some outflow over here. I'm fine with that. What is the bracket doing? The bracket is telling me this part, that is from C28 till C26, this bracket. This tells me the present value of the numbers in the first 5 years, whether the money is coming in or going out. So I know this is the present value of the cash flows that are coming in or going out in the first 5 years. And then I just deduct the initial investment. Okay. Another question: in the first method, if cash flows are different, we'll have to calculate each present value separately and then add it. Yes. So again, that will be time consuming. So let's say you don't have an annuity over here, but let's say you got different numbers. Let's say you've got 40 over here, then you've got 50 over here. So again, you can't use the concept of annuity, and you'll have to calculate present value of inflows separately for the 5 years and then add them up and then get the total present value of cash inflows. So it's better that you directly use the formula of NPV, because NPV will tell you what is the present value of these in numbers, whether they are constant or they're not constant, whether money is coming in or whether money is going out. So the moment I use equal to NPV and I insert the bracket, I get the present value of these 5 numbers, be it inflow or outflow, be it annuity or a non-annuity number. Any other question, any other doubt with NPV? Okay. Fine. Let's look at the next question. So let's say you're implementing a project where you're considering to purchase a new machine and you've got two alternative machines, machine A and machine B. Now, both these machines will cost you 4 lakhs. So today, if you go and buy machine A, you'll spend 4 lakhs. Similarly, if you go and buy machine B, you'll also spend 4 lakhs. And the cash flows are given. So if you buy machine A, these will be your cash inflows for the next 5 years. And if you buy machine B, these will be your cash inflows for the next 5 years. The question is, which machine should be bought if your discount rate is 10%? So what you have to do is you'll have to calculate the NPV for machine A, calculate the NPV for machine B, and then I'll choose that machine, whichever machine generates a higher NPV. So I've already solved it. You've got the solution over here. So again, I'll directly use equal to NPV. So what is my rate? My rate is 10%. So I write this rate of 10%, which is this 10%. Then I select all the values from the first year to the last year. So I'll get the present value of these inflows, but I also need to deduct my outflow. What is my outflow? My outflow is 4 lakhs. So I've deducted 4 lakhs. So I'll get the NPV from machine A, which comes to 1,19,018 rupees. I do the same thing for machine B. So again, the rate is still the same, which is 10%. I select the values from the first year to the 5th year. So this bracket gives me the present value of cash inflows for the first 5 years. And then I deduct the cash outflow. What is my outflow? Present value of cash outflow, 4 lakhs. So what I get is 1,23,000. 123 is bigger than 119. I'll go with machine B. Any doubt with example number 2 as far as NPV is concerned? Net present value. Yeah. Any questions on NPV before we look at, let's say, I think profitability index? Okay. Then let's look at profitability index. Profitability index, some people also call it as desirability factor. Some people call it as a cost benefit ratio or benefit cost ratio. And this is typically used when, let's say, your investments are different in different projects. Okay. So let's say I've got two projects, that is machine A and machine B. But machine A cost me 10 lakhs, machine B cost me, let's say, 5 lakhs. So initial investment is different. I cannot directly use the concept of NPV and decide, should I go with machine A or should I go with machine B? So in such cases, I'll use the concept of profitability index or desirability factor. Now, what is profitability index? Profitability index is nothing but present value of cash inflows divided by present value of cash outflows. So that's how you calculate your profitability index. Let's take an example. Let's say I do the calculation and I get my present value of cash inflows and I get my present value of cash outflows. So let's say the numerator is 10, the denominator is 5, and I get a profitability index of 2. What does it mean? It means for every 1 rupee that I'm investing, I'll generate 2 rupees as inflow. Because what is this 10? Present value of cash inflow. What is this 5? Present value of cash outflow. So 2 means it is nothing but 2 by 1. So 1 is nothing but your outflow. 2 is nothing but your inflow. So for every 1 rupee of money that is going out, you will generate 2 rupees and that 2 rupees will come in. So you'll have to calculate the profitability index of, let's say, machine A and machine B. And let's say machine A gives you a profitability index of 2. Machine B gives you a profitability index of 3. Then I'm saying for machine B, for every 1 rupee of money that I'm investing, I'll generate 3 rupees. But for A, for every 1 rupee of investment, I'll generate only 2 rupees. So in that case, I will go ahead with machine B because it has a higher profitability index. So profitability index is used when initial investments are different. You cannot directly compare them on the basis of NPV. So again, I have a few examples over here. Let's look at these examples. Okay, so let's look at the first one. So let's look at this example, which is example number 3. Now, in this question, what they've done is they've already given you the profitability index, and they're saying a profitability index is 2, which means present value of cash inflows upon present value of cash outflow is given as 2. They're saying present value of cash outflow is 2000. So the denominator is given as 2000, which means you can easily calculate what's your numerator, which is the present value of cash inflow. So present value of cash inflow will be nothing but 2000 into 2. You'll get your present value of cash inflow as 4000. Any questions till here? How do you calculate your present value of cash inflows? So present value of cash inflow is 4000. I've done the same calculation over here. Present value of cash inflows is 4000. Any doubt till here? Okay. Now in this question, you knew the present value of cash outflows, you knew your profitability index. What they're saying is calculate NPV. Now, how do you calculate NPV? NPV is nothing but present value of cash inflows minus present value of cash outflow. So present value of cash inflow is 4000. Present value of cash outflow is 2000. So what will be my NPV? NPV will be 4000 minus 2000. That's present value of cash inflow minus present value of cash outflow. So you get an NPV of 2000. Any doubt with this example? So profitability index is nothing but it's like an extension of NPV, because I'm using the concept of NPV as far as profitability index is concerned, and I can calculate NPV if they give me profitability index. So as a thumb rule, what does it tell you? It says if profitability index is more than 1, which means, let's take this example. When I got my profitability index as 2, then I'm saying my NPV is positive. Why? Because my inflows are more than the outflows. It's only then that I'll get a profitability index which is more than 1. And if that is the case, then my NPV will be positive. In this case, it is positive. Similarly, let's say you get a profitability index which is less than 1. So let's say present value of cash inflow upon present value of cash outflow. So let's say this is 800 and this is 1000. So you get a profitability index of 0.8. So you get a profitability index which is less than 1. Now, the moment you get a profitability index which is less than 1, and somebody tells you what will be the NPV of the project, what is NPV? Present value of inflow minus present value of outflow, which means it will be 800 minus 1000, which means your NPV will be negative. And if profitability index is 1, which means your numerator and denominator are the same. So let's say this is also 1000. Denominator is also 1000. You get a profitability index of 1. So what will be your NPV? Inflow minus outflow. That's 1000 minus 1000. You get an NPV of 0. So that's the relationship between profitability index and NPV. Any doubt with this relationship, profitability index and the NPV? Yep. Any questions on this? Profitability index NPV. So if your profitability index is more than 1, you're telling me that your NPV is positive, you should accept the project. Because initially we also said that if NPV is positive, we'll accept the project. If NPV is negative, you will reject the project. If NPV is 0, then we leave it up to the management to decide what is to be done. Again, this is from a classroom perspective, exam perspective. Practically, if my NPV is 0, I'm not even accepting the project. If it's slightly positive, I might still reject my project unless and until my NPV is at least 20 to 25% of my investment. So in a real life situation, I mean, you'll never face a question over here, what should be done? Should I accept it or reject it? If NPV is 0, you're not even touching that project. Any questions with this before we look at example 3.1? Okay, then let's look at example 3.1. I've just added this, so maybe it will not be there in your sheet because I just added it a few days back. So just let me know whether this is there or it's not there. I don't think it should be there. Is it there in your sheet? This example? No, fine. Again, it's a very simple example. You can solve it parallelly with me. Okay, so let's solve it parallelly. So what is done in this case? I've got two products or two machines or two projects. I've got project X and I've got project Y. And I've got the data for the next 5 years. So they're telling me how much am I spending today in the 0th year and what are my inflows in the first year, second year, third year, fourth year, and the fifth year. Now, for project X, they're telling me that I'm spending 27 today. And for project Y, I'm spending 40 today. And they've given me the cash flows for the next 5 years for project X, which is 0, 5, 22, 14, and 14. And for project Y, it is 10, 14, 16, 17, and 15. And they've also given me the discount rate, which is 10%. So what I'll do is I'll calculate the profitability index. And when I calculate the profitability index, I get an answer of 1.44 and 1.34. So let's look at how do you calculate your profitability index. So how do you calculate your profitability index? Profitability index is nothing but present value of cash inflows upon present value of cash outflows. Now, this numerator, that is present value of cash inflows, for this, I'll use the formula of NPV. Okay. So let's look at the numerator. I'll write equal to NPV. I'll insert the bracket and then I'll have to insert these numbers. So the rate, what is my rate? Rate is 10%. Then I'll enter the numbers from the first year to the fifth year. That's 0, 5, 22, 14, and 14, which means K58 to K62, and I'll close the bracket. So this part, which is equal to NPV from the opening of the bracket till I close the bracket, this will tell me what is the value of these 5 numbers at 10%. Fine. So I get my present value of cash inflows. And then I need to divide it by the present value of cash outflow. So I'll just divide it by minus 27. So that is because this is already in terms of present value. So I don't have to calculate the present value. So numerator is the present value of cash inflows. You divide it by the outflow, which is minus 27. You get your profitability index, which is 1.44. So again, when you're calculating your profitability index, please don't write minus 27 over here, because I'm taking the present value of cash outflow. So ignore the sign over here. So just ignore it and just write 27. So denominator, I'll write 27. Numerator will be the present value of all of this. You'll get your profitability index as 1.44. Here it is 1.34. So on the basis of profitability index, X is better compared to Y. Any doubt with example 3.1? Yep. Any questions on profitability index? Okay. I've got a question for comparison of two projects of unequal duration. What should we use, NPV or PI? We'll cover that. So if I have projects where the life is different, so let's say project X has a life of 5 years, but project Y has a life of, let's say, 8 years. Then in that case, what you use is an equivalent annualized benefit factor. So we'll cover that. So we'll cover it, don't worry. So we'll cover EAB. So we'll reach there, don't worry. So if you still want, I'll just scroll it down and then you can just look at it. I'll explain it in some time. So we'll look at it over here. So this is used when projects have different lives. So one project has a life of 5 years, another one has 10 years. I cannot directly compare them. So I use this concept of equivalent annualized benefit. So we'll cover that. Yep. Any other query with profitability index before we look at IRR, internal rate of return? Yep. Any doubt with this example 3.1? Okay. Then let's move to IRR. Okay. Can someone tell me what is the meaning of IRR? Not the formula. What is the meaning of IRR? So let's say if I want to explain IRR to a layman who's not from a finance background, how do I explain that? Return on investment. Great. So what is IRR? I mean, you look at the definition, it says IRR is that rate at which NPV is 0, or it is that rate at which present value of cash inflows is equal to present value of cash outflows. Now, if I want to explain it to someone who is not from a finance background, he will not even understand what is NPV, what is present value. So what is IRR? IRR is nothing but the rate of return that is being generated from the project, or how much return are you getting from that project. So IRR is the return that you're generating from the project. And let's say if you are generating a return of 20% and your cost is 15%, it is beneficial because your return is more than the cost except the project. But let's say your return is 20%, but your cost is, let's say, 30%, which means you're raising funds at 30%. You're investing that fund in a project and that project is generating only 20%. It doesn't make sense to invest money in that project because your return is lower than the cost and it will not be a good project to be undertaken. So when you're looking at IRR, calculate your IRR and compare it with your cost of capital. So calculate your IRR, compare it with your cost of capital. As a thumb rule, if IRR, which is your return, is more than the cost of capital, accept the project. If IRR is less than cost of capital, reject the project. And if IRR is equal to cost of capital, the management will take a decision what is to be done. So you're telling me that you're raising funds at 20%, you're investing it in a project which is also generating 20%, which means you are indifferent. So now the management has to take a call whether the project should be accepted or rejected. So this is the thumb rule as to what is to be done with the IRR. Calculate your IRR, compare it with the cost of capital, and then see whether you should accept the project or reject the project, or you are indifferent. Now, let's look at how do you calculate IRR. So the real definition of IRR is this, which is typically given in the books. IRR is that rate at which NPV is 0, which means it is that rate at which present value of cash inflows is equal to present value of cash outflow. Because how do you calculate NPV? Present value of cash inflow minus present value of cash outflow. And if you want your NPV to be 0, which means you're telling me present value of inflow minus present value of outflow is 0. So present value of inflow is equal to your present value of outflow. So IRR is that rate at which either NPV is 0 or present value of inflow is equal to present value of cash outflows. So let's look at a question as to how you calculate your IRR. Now on Excel, life is easy. You can easily calculate your IRR using the IRR formula. But again, when I was a student and I was learning it, especially let's say during my graduation days, during my BCom and all that, when Excel was not allowed in the exam, we had to use trial and error method. So that is tedious. You can make errors. But now with Excel, life is simple. Just use the formula, get the answer within seconds. So let's say I've got two projects. I've got project A and I've got project B. Project A investment is 27, project B investment is 40, and then I've got these cash flows for project A and I've got these cash flows for project B. Discount rate is 20%, which is nothing but so this becomes my cost of capital. So I am raising funds at 20% and I want to invest it in project A and project B. So let's look at what is my IRR from these projects. What is the return that I'm generating from these projects? So to calculate IRR on Excel, I'll just write equal to IRR. I'll insert the bracket. Once you insert the bracket, it says select the values. So you'll select all the values, even the value of the 0th year. So all inflows, outflows from the 0th year till the last year have to be selected. So you select all the values and then it says guess. So either you just leave it blank and you close the bracket, or you can enter any guess number. Guess is what is your estimate of your IRR. So you feel that no, it is, I feel that my IRR in this case is, let's say 10%. So you could just write comma 10%. Or if you just feel that no, it's a waste of time, just close the bracket and enter it. The Excel will calculate and tell you what's the IRR. So for project A, IRR is 21.97%. For project B, your IRR is 21.6%. So for both the projects, your return is more than your cost, because your cost was 20%. Return over here is 21.97. Here it is 21.61. So any doubt with IRR? Yeah. Any questions on IRR? Okay, I've got a question. What is XIRR? Anyone? We'll cover IRR versus NPV pros and cons. We'll cover that. Don't worry. We'll do that. So, because you've asked this question, NPV is always better than IRR. We'll discuss why NPV is better than IRR. So given an option, if I have to choose between IRR and NPV, I'll always fall back on NPV, not on IRR. We'll discuss it why. First, let's discuss this. What is XIRR? Anyone? What is XIRR? Anyone who can tell me? IRR is even frequency. Fine. Now, when do you use XIRR? XIRR is used when the cash flows are at different dates. Okay. So let's say over here, what I'm doing is I'm assuming that my cash flows are happening evenly. That is in the first year, second year, third year, fourth year, fifth year. Now let's assume these are not happening evenly. That is after one year. Let's say I get my first cash flow on 1st of Jan, and let's say that's 10 crores. Then I get something on 5th of Jan, which is, let's say, 20 crores. Then I get something on 31st of Jan, which is, let's say, 2 crores. In this case, I cannot use IRR because my cash flows are not arising evenly. So first cash flow, the second cash flow, there's a gap of only 4 days. The next cash flow, there's a gap of like 26, 27 days. So in this case, I'll have to use the concept of XIRR. So XIRR is used when your cash flows are not arising evenly, but they're coming at different date and different intervals. Okay, so why is it used in mutual funds? Now in mutual funds, now let's say I'm doing an investment. So let's say I have got Axis Blue Chip Fund. Okay. Now when you're doing investment, it is not necessary that you will do investments every month. Okay. So on the same date. Okay. So let's say I do the first investment worth 10,000 in this fund on 2nd of Jan. Then I'm struggling with money in the month of Feb, and I suddenly do an investment in the month of March, and I do it on 10th of March worth 30,000. Then let's say again I'm struggling with the funds, and I do the next investment in the month of June, and I do it on 30th of June worth, let's say, 7,500. So in that case, when I want to calculate what's the return, I will do it as XIRR and not IRR. Because people normally will not invest the same amount on the same date every month or every year. So that is why when you are doing investments in the market, typically people use XIRR because they want to get rid of this anomaly where the cash flows could come at different dates. Okay, fine. Now let's look at the other question which was there, which said IRR NPV pros and cons. Okay. Anyone who can tell me, what do you think is the pitfall of IRR? What are the shortcomings of IRR? And why people say that you should prefer NPV compared to IRR? Yep. Anyone? Let's say 1 or 2 pitfalls is also fine. Yep. Anyone? Okay, let's look at it. Negative NPV can still get a higher IRR than cost of capital. Okay, IRR gives different meaning for lending and borrowing. Fine. Projects might have different multiple IRRs, doesn't consider reinvestment options. Fine, great. Okay, let's just look at these options that you've given. So let's look at, let's say, IRR and NPV. Now, let's say if I'm calculating IRR, then the implicit assumption in an IRR, so let's say these are my cash flows 0, 1, 2, 3, 4. I've invested 50, I'm getting 60, 70, 80, 90. And when I calculate IRR and I do the calculation on Excel equal to IRR and I select these values, then the implicit assumption is that these cash flows which are getting generated in the first year, second year, third year, and the fourth year, they get reinvested at IRR. So let's say I calculate my IRR and my IRR for this project comes as 28%, which means I'm assuming that this 60 crores or 60 lakhs will get invested in some other project and that project will give me a return of 28%. This 70 will get reinvested and I'll get 28%. This 80 will get reinvested in some other project and will generate 28%. This 90 will get reinvested somewhere and will generate 28%. This may not be a realistic assumption because it's not, let's say, I mean, it may be a possibility, but there's always a possibility that you may not have projects where you get a return of 28%. You could have projects where you're generating a return of, let's say, 15%, 16%, 10%, or maybe even 2%. So these cash flows may not get reinvested at 28%, but could get reinvested at a rate which is more or less than 28%. So what is a better assumption? The better assumption is that these cash flows get reinvested at your cost of capital. So let's say my cost of capital for this project is, let's say, 9%. So cost of capital, I assume that 60 rupees or 60 crores gets reinvested at 9%, 70 gets reinvested at 9%, 80 gets reinvested at 9%, and 90 gets reinvested at 9%. Now, why is this more logical compared to assuming that your reinvestment happens at 28%? If there is someone who's ready to lend you at 9%, there's a possibility, a higher possibility, that there'll be someone to whom you can fund at 9%. So there'll be someone who comes to you and says, I also want money. Can you lend money at 9%? So finding projects where you can get 9% is much more easier than finding projects where you can generate a return of 28%. So in IRR, we assume that the cash flows are getting reinvested at 28%, but in NPV, you assume that the cash flows will get reinvested at 9%. So that's again a big advantage for NPV, because of which people say that NPV is better than IRR. Any doubt with this before we look at other reasons why NPV is better compared to IRR? Okay, then let's look at the next one. When I'm calculating IRR, I could generate multiple IRRs. So I could have this difficulty that I generate multiple IRRs. Now, what do you mean by multiple IRRs? And when do you get a situation of multiple IRRs? This situation arises when you do not have a situation where you have only a cash outflow in the 0th year and you have cash inflows after that. Let's look at a typical real life situation. Let's say you're running a business. It's not necessary that in the 0th year you will invest 100 rupees and then from the first year, let's say till the 10th year, only money will come in. There could be a possibility that in the 6th year, you're doing some renovation because of which there is an outflow. So let's say in the first year you generate 10, then you generate 20, 30, 40, 50. And in the 6th year, you are investing 20 crores for renovation of your business, for expanding capacity, for buying more assets, something. And then again in the 7th year, 8th year, 9th year, 10th year, there are inflows, which means you can have multiple outflows also, rather than just having one outflow in the beginning and then only inflows. So if you have a situation where you have multiple inflows and multiple outflows, you will get multiple IRRs. And every time the sign changes, you will get those many IRRs. So here, how many times are the sign changing? From negative, it became positive. and then from positive, again, it became negative. So you have two outflows. So you will get two IRRs. So fine, I'll get two IRRs. Now the question is, which IRR do I take to take a decision? So let's say I get two IRRs. One IRR is 10% and the other IRR is 18%. And I have invested money in this project by taking loan at 12%. So this is my cost of capital. So I've gone to a bank, let's say SBI. I've taken a loan of 12% and invested money in this project. IRR is what? IRR is the return that is being generated by the project. So when I want to compare the return with the cost, should I compare 10% with 12% or should I compare 18% with 12%? So because you can have multiple IRRs, you're not too sure whether your actual return is 10% or 18%. And should you compare 10 with 12 or should you compare 18 with 12? And therefore, what decision should you take? Is it a good project or a bad project? But look at NPV. You will get only one NPV. You will not get multiple NPVs. So again, that's something which gives an upper hand to NPV, that NPV is superior compared to IRR. So because you can have multiple IRRs and everything, therefore, some people also suggest that instead of using IRR, what you should do is you should use the concept of MIRR, which is modified internal rate of return. So in case of modified internal rate of return, what happens is you get only one rate of return. So you get only one rate of return in case of MIRR, rather than, let's say, you could get in IRR, you could get multiple rates of return. So you get a 3, 4, 5, depending upon how many times the sign is changing, how many times the money is going out in the business. And this is bound to happen in a real life situation. You'll not have a real life situation where you invest the money only upfront, that is in the 0th year. And then as long as you run the business, let's say for the next 50 years, only money is coming in. No, you'll have to expand business. You'll have to meet competition. You'll have to do advertisement campaigns and so on and so forth. And there would be years where inflow is less, outflow is more, and therefore your net outflow will be a negative number. So sign will change, and every time the sign changes, you'll get one more IRR. So that's again a big loophole, or not a loophole, a drawback for IRR. Any doubt with this, anyone? So we look at how do you calculate IRR. So MIRR. So we look at how do you calculate MIRR also. Okay. And let's look at the next one. Why NPV is better than, let's say, IRR? NPV is in absolute terms. So let's say NPV comes as, let's say, rupees 10 crores. But IRR is in percentage terms. And this could be misleading sometimes. So when NPV is in absolute terms, it tells me how much wealth has gone up, how much is the value of the company going up by. But in percentage terms, I could get a misleading number and I could do a wrong interpretation. Let's take an example. Let's say I've got two friends, X and Y. One person is working with, let's say, Goldman Sachs. Other one is working with, let's say, Morgan Stanley. Two great investment banks. Now, this person has a salary of 1 crore and this person has a salary of, let's say, 50 lakhs. This person gets a hike of 10%, which means he's getting a hike in absolute terms of 10 lakhs for the year. This person gets a hike of 15%, but 15% of 50 lakhs is what? 7.5 lakhs. So when I start looking at percentages, Y could be happy saying that, oh wow, I've got a hike of 15%, but then your 15% is on 50 lakhs, his 10% is on 1 crore, his salary has gone up by 10 lakhs, your salary has only gone up by 7.5 lakhs. So this is where if you just look at something in percentage terms, you could, let's say, take a wrong decision. So that's again one big, let's say, drawback of IRR, because you're looking at things in percentage terms, but NPV is in absolute terms, in rupee terms or dollar, euro, whatever you want to call it. Yep. So any other question with respect to NPV IRR before we, let's say, move to MIRR, modified internal rate of return? Yeah. Any questions till here? Okay. Then let's look at MIRR. So what is MIRR? As we discussed, MIRR is a better option rather than looking at just IRR, because in MIRR, I'll get only one rate of return. But in IRR, I could get multiple rates of returns. So let's look at how do you calculate your MIRR. So if you look at a definition of MIRR, what is it? It is that rate at which present value of initial investment, that is the money going out in the 0th year, is equal to present value of all the cash flows at the terminal year, which means in the last year. Again, let's look at an example, then you'll understand the meaning of this definition. So let's say I've got this number, I've got these cash flows. So in the 0th year, I'm spending 1,36,000. And then from the 1st year till the 5th year, I've got these cash flows, 30,000, 40, 60, 30, 20. I've got a cost of capital of 8% and I've got an IRR of 10.69%. So again, if I just look at IRR, I mean, this project seems to be good because return is 10.7%, cost is 8%, fine. Now in this question, I don't have multiple inflows and outflows, so I'm just getting one IRR. But let's say if I get multiple inflows and outflows, I'll get multiple IRRs. Then in that case, I'll always prefer an MIRR. So how do you calculate MIRR? So let's look at MIRR. How do you calculate that? So I've just copy pasted the same numbers over here, which is 0 to 5 and the cash flows. What I'll do is I'll first convert everything, that is these numbers, that is from the 1st year till the 5th year. I'll calculate what is the future value of these cash flows at the end of the 5th year. So again, let me make a timeline so that it's easy. So I've got these numbers 0, 1, 2, 3, 4, 5. I'm spending 1,36,000 today. And I'm generating 30,000, 40,000, 60,000, again 30,000 and 20,000. Before I forget, as a thumb rule, I said that IRR should be compared with your cost of capital, and if IRR is more than cost of capital, you'll accept it. So let's say in this case, my IRR is 10.69%, cost of capital is 8%, I'll accept it. Let's change this number slightly and let's say make this as 8.75%. So your return is 8.75%, cost is 8%. What is your opinion? Accept the project, reject the project, what is to be done? Cost is 8%, IRR is 8.7%, 8.9%, 9%, whatever be the case. Accept the project, reject the project. What will you do? Reject, risk involved. Great. Again, but in the exam, please write accept the project. Huh? So for a classroom perspective, exam perspective, the moment IRR is more than cost of capital. So let's say your cost of capital is 8%. Your return is 8.00001. Please accept the project. For a classroom perspective, exam perspective. In real life, please reject the project because of the risk involved, the uncertainty involved, because we don't know what will happen in future. I'm predicting that these would be my cash flows. I mean, my cash flows could go up and down, my market share could go up and down, my cost could go up, my selling price could go down, and therefore I want that buffer or cushion. So as a thumb rule, what happens in the industry when somebody is implementing a project, your IRR should be greater than your cost of capital by at least 3 to 4%. So in this case, if my cost of capital is 8%, my IRR should be at least 11 to 12%, and only then would I even look at these numbers, and then we'll debate whether the project should be accepted or rejected. If my IRR is less than 11%, don't waste your time and my time and bring it before the board and then say that let's decide whether we should put, let's say, 10 crores, 30 crores, 100 crores in this project or not. So theoretically, IRR is more than cost of capital, except the project. Practically, your IRR should be at least 3 to 4% more than your cost of capital. Again, let's move back to MIRR. So this is what is happening in this project, 1,36,000 invested, and these are my cash flows. Now, in case of MIRR, what I'll do is I'll calculate the future value of this 30,000 at the end of the 5th year. I'll calculate the future value of this 40,000 at the end of the 5th year. Okay, question, WACC is the same as cost of capital? Yes. So some people call it as WACC, which is weighted average cost of capital. Some people just call it as cost of capital. But this cost of capital is weighted average. So, I mean, people just use it as WACC, or you just call it as cost of capital. Then I'll calculate the future value of this 60,000 at the end of the 5th year. This 30,000 future value at the end of the 5th year. This 20,000 is already in terms of the value at the end of the 5th year. So I don't have to calculate the future value of this 20,000. So what I'm doing is all inflows and outflows which are happening from the 5th year, the 1st year till the 5th year, I'll calculate the future value of this. Now, when I want to calculate the future value, I need a rate. So what is that rate? That rate is generally your cost of capital, which means you're assuming that this 30,000 will get reinvested in some other project till the 5th year at your cost of capital. This 40,000 will get reinvested in some other project till the 5th year at your cost of capital. Again, we discussed this as one of the drawbacks of IRR, because in IRR, you're assuming that your inflows and outflows in the middle get reinvested at IRR. But in NPV, these inflows are getting reinvested at cost of capital. So MIRR also takes care of that these intermittent cash inflows will get reinvested at your cost of capital, which is a much more realistic assumption than assuming that your inflows are getting reinvested at your IRR. So what I'm doing is I'm calculating the future value of 30,000, 40,000, 60,000, 30,000, and 20,000. So I'll calculate the future value of this 30,000. So I want to calculate the future value of this 30,000 at the end of the 5th year. So I'll use equal to FV and I'll insert the bracket. So I'll say, what is the rate? Rate is 8%, which is my cost of capital, because assuming that these cash flows are getting reinvested at cost of capital. So my rate is 8%. N per is what? 4 years, because this 30,000 will get reinvested for 4 years. So that's 1, 2, 3, 4. So this 30,000 is getting reinvested for 4 years. So I'll take N per as 4 years. There is no PMT. There's only one cash flow. And what is my cash flow? That is I-99, which is nothing but this 30,000. So this 30,000, if it is reinvested for 4 years at 8%, the value at the end of the 5th year will become 40,814.67. Any doubt with this? So this is nothing but future value at the end of the 5th year of this 30,000. So this 30,000 will become 40,814. Any doubt with this? I'll do the same thing with the other numbers. So I'll calculate the future value of this 40,000. So the future value of this 40,000 is 50,388. Calculate future value of 60,000, 30,000, and 20,000. You'll get these numbers. Just go through this and let me know if you're struggling with any of these numbers, the future value. Just go through this, let me know if you have a doubt or a query with these numbers. So if you look at the second year cash flow, this 40,000 will get reinvested for 1, 2, 3 years. So I've taken 3 years. Similarly, this 60,000 will get reinvested for 2 years. 30,000 will get reinvested for 1 year, and 20,000 will remain 20,000 because that's arising at the end of the 5th year. So the future value of 20,000 will remain 20,000. Any questions with these cash flows before we move forward? Okay, fine. So now what I've done is I've converted all these numbers and I've calculated the future value of all these numbers at the end of the 5th year. So now if I sum them up, so I add these numbers. So I add this 40,000, 50,000, 69,000, 32,000 and 20,000. I get a total figure of 2,13,587. So this is nothing but the total future value at the end of the 5th year. So now what do I have? I have a timeline something like this now. 1, 2, 3, 4, 5. So I'm spending 1,36,000 today. I've calculated the future value of all these cash flows and I've got a future value of 2,13,587. So now I'm saying, what is MIRR? MIRR is that rate at which present value of this 2,13,587 is equal to 1,36,000. So look at the definition of MIRR. What is the definition of MIRR? Definition of MIRR is, it is that rate at which present value of initial investment, that is this 1,36,000, is equal to present value of the cash flows of the terminal year, which is this 2,13,587. So now I'll calculate that rate at which 2,13,587 will be equal to 1,36,000. So I have 1,36,000 of outflow in the 0th year. Then there's nothing in the 1st year, 2nd year, 3rd year, 4th year. What I have is a cash of 2,13,587.15 in the 5th year. So now I want to calculate my MIRR. So I'll just write equal to IRR and I'll calculate the answer. So I'll select all the values and I'll get an answer of 9.45. So MIRR is better than IRR because you assume that the investments are happening at your cost of capital and you will not get multiple IRRs. You'll get only one IRR, one MIRR. So IRRs you can get multiple, but MIRR you'll get only one MIRR. So in case you're getting multiple IRRs, it's always better to switch to MIRR and calculate the MIRR. Any doubt with MIRR, modified internal rate of return? Fine. So the definition says present value, but we are taking future value. We are converting everything into future value and then we are calculating the present value. So I'm saying I want that rate at which present value of 2,13,587 is equal to 1,36,000 and that rate is coming as 9.45. So first I convert everything into future value. So I convert this into future value, this into future value, this into future value, this into future value. And at what rate? At cost of capital. So I'm getting rid of one of the drawbacks of IRR, which was assuming that reinvestments are happening at IRR. Over here, I'm assuming reinvestment is happening at cost of capital. So now once I get the future value, now I'll calculate that rate at which present value of this is equal to present value of 1,36,000. So first convert everything into future value, go back to the last year, and then again calculate that rate at which present values will tally and match with each other. Yeah. Any doubt with MIRR? Anyone struggling with MIRR? Any questions on MIRR? Okay. So we are done with NPV, we are done with profitability index, we are done with IRR, and we also discussed MIRR. Any doubt till here? So should we continue with these two, or you want to take a break and then continue? And then we'll also have to cover this. So these three parts are left. So we take a break and then continue, or we continue it. Okay, we'll take a break then. So after the break, there are three things that are left. We have to look at this concept of equivalent annualized net benefit. We look at the concept of capital rationing, and we'll also look at how do you calculate your cost of capital. Because till now, what we are assuming is that this cost of capital is always given to us in the question. Cost of capital is 10%, 15%. Now the question is, how do you calculate that 10%, 15%, 20%? Okay. Question is, when do you use IRR over NPV? If I have to choose between IRR and NPV, I'll always prefer NPV. So see what will happen in most of the cases, your NPV and IRR will give you common results. For example, let's say I have to choose between two projects X and Y. I'll get NPV and I'll get IRR. So let's say NPV over here is 10,000, NPV over here is 5,000, which means on the basis of NPV, I'm saying choose project X. IRR in most of the cases will say that IRR is, let's say, 10%. Over here, IRR will come as, let's say, 9%, which means IRR will also tell me that I have to choose X and not Y. But in case the numbers are different, let's say this is 9% and this is 10%, which means NPV is telling me choose project X. IRR is telling me choose project Y. I will always go with NPV and not with IRR, because NPV is a superior method compared to IRR. So if there is a misleading result and IRR and NPV tell you to accept different projects, always go with NPV. And I will say in this case, I will choose X, I will not choose Y. Even though IRR is telling me to go ahead with Y, NPV is a superior method, I will choose X. Yep. Any other questions? Otherwise, we take a break. Okay. So let's take a break. It's 8:19. Let's resume at 8:30. So we resume at 8:30. Okay, so let's resume. Let's look at the concept of equivalent annualized benefit. So this is used when projects have different lives and you directly cannot take a decision on the basis of your NPVs. So let's take an example. So you have example number 6 over here, where there are two projects. You've got project A and you also have project B. Project A has a life of 5 years. Project B has a life of 10 years. NPV is given as 5328 and over here it's given as 8,000. And the discount rate or your cost of capital for both the projects is 10%. Now, if I directly take a decision on the basis of NPV, I would say that project B is better because project B has an NPV of 8,000 compared to project A, which has an NPV of 5328. But that will be a flawed decision. It will be a wrong decision. Why? Project B has a life of 10 years, but project A has a life of 5 years, which means I can implement project A twice, because if I implement project A twice, I'll take 5 years and 5 years. So this will be 5 years, this will be 10 years, this is 10 years. So project B has a life of 10 years, it can be implemented only once. But project A has a life of 5 years, I can implement it twice. And the first time I implement it, what is the NPV? I'm getting an NPV of 5328. The next time I implement it for the next 5 years, I'll get an NPV of 5328. So project B is giving me an NPV of 8,000. Project A gives me NPV of 5328 in the 0th year. And it is again giving me an NPV of 5328 at the end of the 5th year, because that is the NPV from the 6th year to the 10th year. So that is at the end of the 5th year. So again, what I'll do is I'll have to calculate the present value of this 5328 at 10%. So if you calculate present value of 5328 at 10%, so let's say I write equal to present value. What is my rate? My rate of return is 10%. So I'll take this 10%. Then what is my NPER? My NPER is 5 years, because I need to calculate the present value for this value which is arising at the end of the 5th year. There is no PMT. And what is my future value? My future value is nothing but 5328. So minus 5328. So I'll get a present value of 3308.27. So the present value of this 5328 at the beginning of the 0th year is 3308. So when I add this 3308 and 5328, what I get is 8636.27. So A is generating an NPV of 8636. B is generating an NPV of only 8,000. So now I clearly know that it's better to go ahead with project A and not with project B. This method is known as the LCM method, because what I'm trying to do is I'm trying to calculate the common multiple. So the common multiple of 10 and 5 is 10 years. So I'll implement the project twice. So any questions with this? But then again, this method, typically people will not use it, because let's say I have a project, one project has a life of 7 years, other one has a life of 17 years. So again, how many times do I replicate and implement the project? That becomes tedious and time consuming. So again, if you just have simple numbers like 5 and 10, it's easy. You can still do it and get an answer where you clearly say that you will go ahead with project A. Any doubt with this method? Otherwise, we look at the other method where we can use a shortcut and decide whether I should go with project A or project B. Okay, I'm sorry, I just saw the chat box now. Just let me look at it. It says one question from a practical standpoint, say I'm opening one local grocery store by investing some amount X. Now, if I get my cash flows for the next 5 years by say demand forecast, then that may not be reaching to the break-even point to get me positive NPV. Maybe I'll need sales figures of 10 years to arrive at a positive NPV. So what is typically done in this case? How many years of cash flows is to be taken into account for NPV calculation? Now, for calculating your NPV, you need to take the cash flows for as long as you will be continuing the business. So if you feel that no, once you open that grocery store and you'll be running that business for the next 20 years, you'll need cash flows for the next 20 years. If you feel that no, you'll be running that business for the next 10 years, you'll need cash flows for only 10 years. Okay, fine. Next question that I got is, I'm still confused how with Excel you get multiple IRRs when the cash flows will both have positive and negative numbers. Okay. Yeah, so let's look at this. Okay, so I have this Excel sheet where I've got multiple IRRs. I've got two IRRs. So I've got IRR 1 and IRR 2. So over here, what I have is I've got two outflows. So let's look at this. Do you have this sheet or no? I don't know whether you have this sheet or not. Do you have this sheet? Okay, fine. I mean, again, from an exam point of view, you will not get a question where I tell you to calculate multiple IRRs, but then I'm just explaining it. How do you calculate, let's say, multiple IRRs in case the sign changes? So what is happening over here? The sign is changing twice. So you have a negative number and a positive number. So it's changing once. And then again from positive to negative. So which means the sign is changing twice. So if the sign is changing twice, you'll have two IRRs. So how do you calculate two IRRs? So let's say I want to calculate the IRR. So I want to calculate the first IRR. Again, this is a trial and error method. So again, it could be a little time consuming. So let's say I select all the numbers. And then what I do is I insert the guess number. So let's say I insert guess and I insert 2. Okay. So I insert 2, which means I'm assuming that IRR for this project is 2%. And I get an answer of 3.5%, which means this is one IRR, which is 3.5%. Now, I clearly know that in this case, I should be getting two IRRs, which means one IRR is 3.5%, but I need to have another IRR because the sign is changing twice. So now I'll again do the calculation for IRR. I'll select all these numbers. And when I write a guess number, I'll not write a small number. I'll write some other number, maybe 15%, 20%, 30%, 40%. I've randomly written 25%. Now, when you enter, you get another IRR, which is 19.5%. So that is how you'll get multiple IRRs in case you have multiple times the sign is changing. Yeah. So this is how you do it. But then again, over here, you'll have to use the concept of guess. You'll have to enter the guess number and you'll have to make an assumption. Take any number, 15%, 20%. That is how you get it. Okay, then we may enter any other number and get another IRR. So it does not depend upon the sign change. It definitely depends on the sign change. So I clearly know that I'll get two IRRs over here because the sign is changing twice. Now the question is, how do I get IRR? Now let's say if I just enter another number over here, let's say I enter 5% over here. I'm still getting this 3.5% because the guess number is very close to the actual IRR that I've got, which is 3.5%. So now I know that I need another IRR. That IRR will be some other number. So take some higher number. So that is the reason why I did not take 5% or something. I just took it as 25%. So whatever is the second IRR, it will throw that second IRR to me, which is coming as 19.5%. Now in this question, I've got two IRRs, 3.5 and 19.5. And let's say my cost of capital is 10%. So I know that project is returning 3.5%. Project is returning 19.5%. Cost of capital is 10%. Now, this is extremely confusing. What should I do? Should I take my return as 3.5%? Because if I take my return as 3.5%, then I'm saying I'm earning 3.5%, cost is 10%, reject the project. But if I take my return as 19.5%, I'm saying return is 19.5, cost is 10, accept the project. So this is again a big drawback for IRR. And if you look at MIRR, you will be able to solve this question using MIRR. You will get only one IRR. So I think I've solved it using MIRR also. Yeah, I've solved the same question using MIRR. And when you solve it using MIRR, you get only one MIRR, which is 10.89%. So again, you're saying that your return is 10.89, cost is 10%, reject the project. So if I just look at IRR, it's confusing. Do I accept it? Do I reject it? I have no idea. Because should I take 3.5? Should I take 19.5? I have no idea. So what I do is I switch over to MIRR. I get only one MIRR. So I'm saying that MIRR is 10.89%. Cost is 10%. Sorry, I said I'll reject the project. I'll accept the project. So return is 10.89. cost is 10%, return is more than the cost, I will accept the project. Okay. So I've done the same thing. I've calculated the future value, everything. I've converted all these cash flows and calculated, move it to the 10th year. I calculate the future value at the end of the 10th year, and then I calculate my MIRR. Okay. So let's move back to this concept of equivalent annualized benefit. So one way is this LCM method. What is the other way? So look at the other method. Now, what is the other method, which is a shortcut method? We know that how do you calculate present value? Present value is nothing but annuity into the present value annuity factor. And you can calculate the present value annuity factor either using the table or you can do it on a calculator. So either you use the table or you get the present value annuity factor on a calculator. So present value is nothing but annuity into present value annuity factor. So if I go back to this question. So this is the data that's given to me. What I'll do is I'll calculate annuity. So I'll calculate this number. That's this. So present value is nothing but my NPV, because NPV is the value as of today. So I know my NPV. And I'll calculate my present value annuity factor from the table. So let's calculate annuity from the table using the table for project A and project B. So let's say I want to calculate the annuity. So how do I calculate annuity? Annuity will be nothing but present value divided by present value annuity factor. So for project A, what is my present value? 5328. So I've got 5328, which is this. And I'll calculate the present value annuity factor. So I'll go back to my tables. So I go to my present value table. So this is my present value table. Let's look at. Yeah. So this is my present value table. So what I need is, I need the present value factor for 10% for 5 years. So I look at 10% for 5 years. So I look at 10%, but this is my present value factor table. This is not my present value annuity factor table. So I'm saying that my present value factor for the first year is 0.909. Second year is 0.82. Third year is 0.75. Fourth year is 0.68. And then for the fifth year is 0.62. If I add these 5 numbers, what I'll get is my present value annuity factor for 10% for 5 years. So add these 5 numbers, which is 0.9, 0.82, 0.75, 0.68, and 0.62. If you add them up, what you'll get is, you'll get 3.7908. So, or you can also do it on a calculator. So on a calculator, what you'll do is you'll take plus 1 divided by 1.1. You'll get the present value factor for the first year. Then you want the P factor for the second year, this divided by 1.1. You'll get the P factor for the second year. Keep doing it for the next 3 years, sum it up. You'll get the value as 3.7908. So you know your NPV, you know your present value annuity factor, you divide the two, you get an annuity of 1405. You do the same thing for project B. So project B, what is your present value? 8,000 divided by the present value annuity factor for 10% for 10 years, because the life over year is 10 years. So you get your present value annuity factor as 6.1466. And then compare the annuities. I'm getting a higher annuity over here for project A. I'll go ahead with project A. So again, depending upon whatever you're comfortable with, whichever method, you're comfortable with this method, then go with this method. You're comfortable with the LCM method, go ahead with the LCM method. But your answer will be the same. You will say that go with project A. Will we be given this table in the term and exam? Let's say if the table is not given, you can still calculate it, right? So let's say if I want to calculate the PE factor, present value annuity factor. So again, I'll do this divided by 1.1 plus this divided by 1.1 and plus this divided by 1.1. And then I'll just sum it up. So if I sum it up, what I get is 3.7907. So I'm getting the same one, 3.7907. So I was getting the same number. So even if the table is not given, you can do it on the calculator on Excel. 99.9% you will not be given the tables. Alternatively, you can directly do it using the PMT function. So this is what we do it. So this is the question that can't we use the PMT and get it? You can directly do it. You can use annuity and you can get the answer. So I need to calculate the annuity. So what will be my annuity? So let's calculate annuity. How do you calculate annuity? So write equal to PMT. You need the rate. What is your rate? 10%. What is your N per? Number of periods? 5 years. So you get your N per. And what is your present value? Present value is 5328. You'll get your annuity. So let's say you feel that no, this is again a waste of time. I don't want to do all of this. Directly use the PMT function, calculate your annuity. You'll get the same answer, 1405 and 1309. And you'll say go ahead with project A. So again, depending upon whatever is your comfort zone, please pick and choose that. I will never enforce and say, no, you have to use this method or this method or the LCM method. Pick and choose whatever you want. You'll get the same answers. So in case you're looking at projects where the life is different, either use the LCM method or the annuity method, and you'll get the same answer. In this case, I'm saying I'll go ahead with project A, not with project B. Any doubt with this, anyone? Any doubt with the equivalent annualized benefit method? Now, let's say instead of having equivalent annualized benefit, I have equivalent annualized cost. Okay. And I do my calculations and I get my annuities as 1405 and 1301. Which project will you choose? You'll choose A or you'll choose B. If it is not a benefit question, but it is a cost question. If it's a cost question, you will choose B, because when it is cost, you want a lower cost. So I'm saying I get a lower annuity. So let's assume this is your installments that you're paying. Because it's a cost for you, it's an installment. So one bank is saying your EMIs will be 1405. Other one is saying your EMI will be 1301. Which one would you prefer? I'll go ahead with bank B. So again, be careful what's given in the question, whether they are telling you to calculate the benefit or the cost. If it is a benefit, you will go ahead with the higher one because you want a higher benefit for yourself. But if it is a cost, you want a lower annuity. So in that case, you'll go with project B. Okay, so be very careful. Huh? Don't just mug it up and say, I'll go ahead with the highest one. And then you'll do everything correct, but your final answer will be wrong. So maybe you lose 1 mark or so because your final answer will be wrong. Any doubt with this method? Equivalent annualized benefit or equivalent annualized cost? Before we look at capital rationing. Yep. Any questions on this? So we are done with this one also. So we are left with capital rationing and cost of capital. Can we move to capital rationing? Any doubt till here? Okay, then let's look at capital rationing. Anyone who can tell me what do you mean by rationing, or let's say you go to a ration shop. What is a ration shop? What do they do? What is their intention? Why does the government create all these ration shops? Yep, anyone? To give it at a discounted price, enforce quotas, fine. Okay. Now, again, let's look at this. Cheaper price for lower economic classes. Okay, great. Now, let's look at something. You know, human wants are unlimited. Resources to satisfy them are limited, and then problem of choice will arise. Okay. So we want 10 different things. We want A, we want B, we want C in life. Okay, because human wants are unlimited, but we don't have enough money. We have enough money only for, let's say, one. So if we have enough money to buy only A or B or C, then I'll pick and choose either A or B or C, depending upon which one is giving me a better benefit or a higher satisfaction level. So that is the concept of capital rationing. Now, in real life, when you're running a business, you'll always face this problem. So you'll always have a limiting factor. Capital rationing happens when there is a limiting factor or you have a constraint. And you'll always have constraints in life. You'll have only 24 hours. You'll not get more than that in a day. You'll always have limited amount of money. You'll not. So let's say even if you become Mukesh Ambani, you want to become Elon Musk. You become Elon Musk, you say, no, I want more money. So because today you read the newspapers, the buyout of Twitter has been put on hold. So again, he must be thinking about something else. Maybe he's struggling with the funds that he's getting, or whatever be the case. So you'll always have limiting factors. Maybe you'll have limiting factors with the respect of raw material that you have. Maybe you'll have limiting factors with respect to the space that you have to run your factory. Maybe a limiting factor with respect to the number of workers that you have. So you'll always have limiting factors. And whenever you have a limiting factor, you need to use that factor in such a way so that you can maximize and get the best returns. So capital rationing talks about that. When you have limited money, how do I use that limited money and decide which project should I accept and which projects I should reject? So any doubt with the concept of capital rationing? I have limited capital. I need to ration it and use it in a way so that I can maximize my NPV. Any doubt with the concept of capital rationing before we look at a few questions on capital rationing? Okay, so let's look at a few questions on capital rationing. So let's look at the first one. So let's look at the first one. It says X Limited has 7 lakhs. So you're running a business where you have only 7 lakh rupees. There are 4 projects which are all divisible. So I've got project X, Y, Z, W. And the management wants an advice which project should be selected from the following, on the basis of the following data. So I have these 4 projects X, Y, Z, and W. These are my present value of cash outflows. So if I accept project X, I'll have to spend 3 lakhs. Project Y will need 2 lakhs. Project Z will need 2.5 lakhs. And project W will need 6 lakhs. I know the NPV that I'll get from these projects. So if I accept X, I'll get an NPV of 60,000. Y will give me 50,000. Z will give me 1.5 lakhs. And W will give me 1.8 lakhs. I will calculate profitability index. Okay. Because when you have limiting factors, you try and take a decision on the basis of profitability index, because it tells you for every 1 rupee of investment, how much money are you generating? How much is your cash inflow? So let's say the profitability index is given or you calculate it, and you calculate the following profitability index. So for project X, it's 1.2, Y it's 1.25, Z it's 1.6, and W it is 1.3. Now, once you calculate your profitability index, what you'll do is you'll do ranking. You'll rank the projects on the basis of profitability index. So look at project Z. It has a profitability index of 1.6. Okay, I've got a question. Here only we are considering NPV as cash inflows, but actually NPV is cash inflow minus cash outflow. I think, if I'm not wrong, in your async content, profitability index, if I'm not wrong, the formula is not given as present value of cash inflows upon present value of cash outflows. I think the formula given over there is NPV upon present value of cash outflows. Is this the formula which is given in your async content? Yeah. But again, look at your async content. I think if you look at the written matter, it says NPV upon present value of cash outflow. But I think there are 2 professors whose video is there in your async content. The first professor, he uses the formula of NPV upon present value of cash outflow. But the second professor, if you look at this video, he uses this formula, present value of cash inflow upon present value of cash outflow. So again, 2 different professors using 2 different formulas. And this is something which happens in finance. There is no standard rule. But generally people prefer this and not this. But let's say if somebody is using this, I will not say it is wrong, but generally most of the people prefer this first method, which is present value of cash inflow upon present value of cash outflow, and not the second one. But then again, like I said, in your async content, both the formulas are used. The first professor uses this method, which is NPV upon present value of cash outflow. The other professor, when he's giving live examples of companies, he uses this method, which is inflow upon outflow. So depending upon what is the data that's given, you make a choice. Had I been in your position, had I been a student, I would have used the first method, which is commonly used. So I would prefer this method, but let's say if somebody uses this method, I'm not going to say that it's wrong. Okay. So now, once I know the profitability index, I'll do the ranking. So my first rank will go to project Z because it has the highest profitability index, which is 1.6, which means for every 1 rupee of investment, Z will give me 1.6 rupees. So I'll spend 1 rupees, but Z will bring an inflow of 1.6. Second rank will go to W because for every 1 rupee, I'll generate 1.3 rupees. Then the third rank will go to Y and the fourth rank will go to X. So that is how I give the ranks as 4, 3, 1, and 2. Any questions on the ranks? Ranks are given on the basis of profitability index. Any doubt till here? Okay, fine. Now, once I know the ranks and I've given the ranks to different projects, I will then follow those ranks and then decide which project is to be accepted. So I'll first go ahead with the project which has rank 1, which means I'll go ahead with project Z. So I'll go ahead with project Z. I'll implement project Z. But if I implement project Z, how much money will I need? I'll need 2.5 lakhs. So funds required will be 2.5 lakhs. So funds required 2.5 lakhs. What is the total fund that I have? I've got total of 7 lakhs. So again, the question says I have only 7 lakhs. So the total amount of money that I have is 7 lakhs, out of which I've already used 2.5 lakhs, which means I can still use 4.5 lakhs. So let's go to the project with the second rank. So I'll go to the project with the second rank, which is project W. And for project W, how much investment is required? For project W, I need 6 lakhs. But I don't have 6 lakhs. I have only 4.5 lakhs because that's my balancing figure, which is nothing but 7 lakh minus 2.5 lakh. So 7 lakhs is the total fund. 2.5 lakh is what I've exhausted. I can still use 4.5 lakhs, which is still lying with me in the bank. The question says projects are divisible, which means it's not necessary that I accept the entire project. I can accept a part of the project also. So 6 lakhs is needed if I want to take the entire project, but I have only 4.5 lakhs. So I'll take only 75% of the project because 4.5 lakh upon 6 lakh is nothing but 75%. Sorry, not 75%. Yeah, it's 75%. So I'll take 75% of the project. So I'll implement project Z and I'll implement 75% of project W. So I'll invest 4.5 lakhs, which is my balancing figure, and I'll calculate the NPVs. So when I implement project Z, what is my NPV? My NPV is given as 1.5 lakhs. So I take this 1.5 lakhs. But when I implement project W, if I implement the entire project, I was getting 1,80,000, but I'm implementing only 75% of the project. So what will be the NPV from this project? It will be 75% of 1,80,000, which is 1,35,000. So in the 7 lakhs, I will implement 100% of project Z and 75% of project W, and I'll generate a total NPV of 2,85,000. Any doubt with this, anyone? Any questions on NPV? Or let's say your capital rationing? Okay. In case we implement 100% of the project, which is at rank 3, should we take it? Now, again, let's say the question says you can implement only 100% of the project. You cannot accept a part of the project, which means projects are not divisible. So again, then I have to do trial and error method. So I'll say, okay, after I take, let's say, in that case, what I'll do is I'll do trial and error. So I'll say, okay, let's say if I take project X and project Y, which means because I have 7 lakhs, so I can take project X and project Y, which means I'll be utilizing 5 lakhs. What is the total NPV? Total NPV will be 60,000 plus 50,000, which is 1,10,000. So it doesn't make sense for me to take X and Y. So you'll have to do trial and error if your projects are not divisible. So let's say you decide that no, you'll first accept Z, which will generate 1.5 lakh. You still have balance 4.5 lakhs. Then you cannot accept W. So you will either accept X or Y. And which one will you accept? You will accept the one which has a higher NPV. So in that case, I'll say accept X because it will give me 60,000. I'll not accept Y because it will give me only 50,000. So in that case, I'll say, okay, implement Z and implement X because I'll be maximizing my NPV. Because at the end of the day, what is my goal? My goal is to maximize my NPV. So if the projects are not divisible, then you have this issue. You'll have to do trial and error. But if it's divisible, then it's easy and straightforward. Any doubt with capital rationing? Otherwise, we move to cost of capital. Any questions with these 5, or we move to cost of capital? So why not invest 6 lakhs in project W? Okay, let's look at project W. If I invest 6 lakhs in project W, how much will I get? 1,80,000. Okay. So if I invest in project W, but if I invest in, let's say, Z, I will get how much? 1.5 lakh. Plus I'm saying I'll invest in X, which will give me 60,000. Which means how much will I generate? 2,10,000. Which is better? 2,10,000 or 1,80,000? So again, I'll choose a combination of Z and X and not just W. Because at the end of the day, I want to maximize my NP within that 7 lakh rupees. Yeah. Any other question? Otherwise, we move to cost of capital. Okay, so let's look at the concept of cost of capital. Some people call it as cost of capital. Some people call it as discount rate. Some people call it as weighted average cost of capital. So either you call it as WACC or cost of capital, discount rate. Some people call it as hurdle rate. Different names given for the same thing. Now let's try and understand this. Let's say I want to start a business for which I need some funds. So I go to one friend A and I go to another friend B. A is ready to lend me 10 lakhs. B is also ready to lend me 10 lakhs. Which means I'll get 20 lakhs, which is needed for starting my business. So this is the value in rupee terms. A is a very close friend and B is, okay. He's like more of an acquaintance. He's not that close a friend of mine. So when I go to A is ready to lend that money when I'm looking at, let's say, the rate. A is ready to lend that money to me at, let's say, 10% because he's a close friend. He knows me in and out. B is more of an acquaintance. So B says, no, I don't know you that much. So I'll not charge you 10%. I'll charge you more because I don't know how you are, whether you'll do the repayment or not, something of that sort. So he charges me a higher rate, let's say 12%. Now in real life, what will happen? A and B will not be friends. They'll be different banks. So maybe you go to SBI, you go to HDFC. Maybe this could be equity shareholders. This could be lenders. So different people will fund money. They will invest money in your business and they will have different expectations. Somebody will expect 10%, somebody 12%, somebody 20%, somebody 18%. Now I want one rate for my business. So that one rate is nothing but your cost of capital, which is your weighted weighted average cost of capital. So what will be your weighted average cost of capital? Your weighted average cost of capital over here will be nothing but cost of A, which is 10%, into the weight of A. How much is the weight of A? 10 lakhs upon 20 lakhs, which is 50%. Then cost of B, which is 12%, into weight of B, which is again 10 lakhs divided by 20 lakhs, which is 50%. So you'll get your weighted average cost of capital as 11%, which means I'm saying on an average, anyone who is investing money in my business wants 11% return on an average. Some people want 10, some people want 12, but on an average, they want 11% return. Now, if they want a return from me, for them, it is a return. For me as a company, it is a cost because I have to give them that return. So for them, it is a return. For me, it is a cost as a company. And therefore, it is known as cost of capital. Any doubt with the concept of cost of capital, or how do you calculate your weighted average cost of capital? Look at your different sources, be it A, B, C, D, E. Look at the rates, look at the weights, multiply the cost with the weight. So cost into the weight plus cost into the weight, and keep doing it for different sources. You'll get your weighted average cost of capital. These sources could be equity, it could be debt, it could be preference shares, whatever it is. Any doubt with this before we look at how do you calculate cost of equity, cost of debt, and cost of preference? Any questions on this? Anyone? Yeah. So what is this 11%? This 11%, A is not getting 11%. A is getting 10% only. A is getting 10%. I'm saying on an average, people investing money in my company, that is people who are investing 20 lakhs, how much do they want? They want 11%. So 11% of 20 lakhs, that is how much? 2.2 lakhs. So they want 2.2 lakhs, out of which how much does A want? He wants 10% of 10 lakhs, which is 1 lakh. And how much does B want? He wants 12% of 10 lakhs, which is 1.2 lakhs. But on an average, how much do they expect? They expect 11%. So 1 lakh will go to A, 1.2 lakh will go to B. They want a total of 2.2 lakh. 2.2 lakh on 20 lakhs is nothing but 11 lakh. So it's not that A will get 11%. No, A will get 10%. B will get 12%. But on an average, if I'm looking at the entire company, then I'm saying on an average, people want 11% from my company. Basically, your returns should be more than cost to be able to pay back. Yeah. So that is why you look at, so again, look at that concept of IRR and cost of capital. You're saying your return should be more than your cost, because if your return is less, how will you fulfill the expectation of the people who are investing in your company? And if you don't fulfill their expectation, they will sell the share and your company's share price will go down. Can't we just take an average of the rates? Average of 10 and 12 is 11. I can do that provided the investment amount is the same. But let's say the investment amount is not the same. Then I'll have to take a weighted average. Then I can't take a simple average. So let's say I've got two people, A and B. One is giving me 5 lakhs. One is giving me 10 lakhs. This has an expectation of 10%. This has an expectation of 12%. I can't say that my cost of capital is 11% because the weights are different in that case. So that is why they say weighted average cost of capital and not just a simple average cost of capital. Okay. Any other questions before we look at how do you calculate cost of equity, cost of debt, cost of preference? Okay. Let's look at cost of equity. Generally, what is the equity debt ratio while funding a company? Again, there is no standardization. I mean, you look at a typical book will say your debt equity ratio 2:1. That's all stupid. I don't know why do they even do all this and teach all this, but it's given in a lot of books. Books will say a typical debt equity ratio should be 2:1. Look at an IT company. Look at TCS, Infosys, Wipro. These companies have almost zero debt. So they are almost 99.99999% funded through equity. Are you trying to tell me that these people don't know how to manage and run big businesses? So they will have a debt equity ratio of almost 0.0001. But let's say on the reverse, I'm looking at an infrastructure company, maybe Reliance or maybe JSW Steel or any other metal and mining company or any port company, bridge company. Their debt equity ratio could be in the ratio of 2:1, 3:1, 4:1. Their ratios could be extremely high. So these ratios, there's no standard ratio saying that, okay, this should be your standard ratio. And if it is not the case, then it just tells me that, no, you are far away from this number. No, look at what's happening in your sector and accordingly compare yourself with your sector. Okay. So let's look at how do you calculate your cost of equity. So cost of equity is denoted by KE. Okay. And how do you calculate cost of equity? It is nothing but risk-free rate plus beta into equity risk premium. Cost of equity is risk-free rate plus beta into equity risk premium. A lot of people call this as risk premium. So let's try and understand what is cost of equity. Risk-free rate plus risk premium. Let's say you've got 20 lakh rupees, which as of today is invested in some government bond. So let's say you've got a government bond which is issued by the government of India and you've invested 20 lakhs. And let's say currently the government is offering you a return of, let's say, 6.5%. So that's my risk-free rate, because the rate of return which is offered by the government is assumed to be risk-free, assuming that the government will not default. Assuming, that's a big if. Because of late, if you look at the last 15-20 years, a lot of countries have also started defaulting. Look at Greece, look at Argentina. Argentina is like the epitome. Every 4th year, 5th year, they'll raise their hands and they'll say, no, I don't have the money to pay, I'm defaulting. So even now, people have started questioning, can I consider the government bond yield as the risk-free rate? The answer is no. But again, from a classroom perspective, exam perspective, let's keep it simple. Just assume that risk-free rate is the rate of return that you get on a government bond. So let's say government of India is offering you a return of 6.5%. So you've currently invested those 20 lakhs in the government of India bonds and you're getting an assured return of 6.5%. Now you get a portfolio manager who tells you, sir, please take out this money from the government of India bond and invest it in, let's say, Reliance Industries. And I'll give you a return of 6.5% from Reliance. Will you invest money in Reliance Industries and be satisfied with a return of 6.5%? Or you would prefer to invest your money in a government bond and get 6.5%? Okay, I've got an answer of no. Why no? What is the problem? Why can't you invest in Reliance and get 6.5%? More risk, more return. Great. Reliance is not as safe as the Indian government. And if I invest money in a company, the risk is more. And if I'm taking more risk, you will have to compensate me by giving me a risk premium. So let's say I'll tell you, okay, I'm ready to put my money in Reliance, but I want a return of 10% from Reliance. So how do I calculate that 10%? That will consist of 6.5%, which is the risk-free rate, plus the risk premium, which will come as 3.5%, because I want a total return of 10%. So that's a risk-free rate plus the risk premium. So this is a risk premium that you are expecting because you are taking a higher risk by investing money in Reliance, or be it any company, be it Infosys, be it TCS, be it any other company. So if you are getting exposed to a specific company's stock, the risk is more. you want that risk premium. So that is how you calculate your cost of equity. Cost of equity is nothing but risk-free rate plus risk premium. And how do you calculate risk premium? That's nothing but beta into equity risk premium. Again, not getting into the nitty-gritties of this. I mean, just tell me whether this has been covered in your async content, beta equity risk premium or no. If it's not covered, even I'll skip it. No, fine. So just leave it. So what you need to know is cost of equity is risk-free rate plus risk premium. And just understand that risk premium is calculated as beta into equity risk premium. That's it. So just look at this first definition where you say cost of equity is risk-free rate plus risk premium. That's it. Any doubt with cost of equity before we look at cost of debt and cost of preference? Any questions on cost of equity? Okay, and let's look at cost of debt. Cost of debt is denoted as KD. So cost of equity was KE, cost of debt is KD. And how do you calculate your cost of debt? Interest into 1 minus the tax rate. So you'll take your interest into 1 minus the tax rate. Let's take an example to understand it. Let's say I go to a bank, let's say SBI, and I take a home loan. And let's say SBI is charging me, let's say 8%. So that's my interest rate. So I have to pay 8% to SBI on my home loan. But when I take that home loan, or let's say it's not a home loan, it's a business loan, and I make my profit and loss account for my business, I will claim that interest as an expense in my P&L, because of which my expense will go up, profit will go down. And if my profit goes down, my tax that I have to pay to the government will also go down. So my income tax returns, I'll have to pay lower tax because I've taken some loan from the bank on which I have to pay interest. So I have to pay 8% to SBI, but because I'll claim that interest as an expense, my effective interest cost will go down because I'll pay less tax to the government. So let's say I have a competitor who doesn't take a loan. Let's say he will pay a tax of 1 lakh rupees to the government, but because I have taken a loan, I might end up paying a tax of only 70,000 or 80,000. So I'll pay a lower tax because I will claim this interest as an expense. Profits will go down, tax liability will go down. So on an effective basis, my cost of debt will not be 8%, it will be lower than 8%. And how do I do that? I multiply it with 1 minus the tax rate. So let's say you fall in the 30% tax bracket. So I'll take 1 minus 30%, which is 8 into 70%. So your cost of debt will come as 5.6%. So that's your cost of debt. Cost of debt is interest into 1 minus the tax rate. Any doubt with cost of debt? Any questions on KD? Cost of debt. How about inflation adjustment? Inflation is already captured in the interest. Huh? So let's say when you go to a banker will never quote you a real rate. Banker will always quote you a nominal rate. And nominal rate is after adjusting inflation. So let's say the real rate could be 4%. Inflation is, let's say, 5%. The banker will say, I will charge you a rate of 9%. So banker will not give you this breakup. Real rate is 4, inflation is 5. He will say, you want to take a loan from my bank, you'll have to pay 9%, which is a nominal rate, which is after capturing the effect of inflation. Yep. Any other questions on KD before we look at cost of preference shares? Okay. Then let's look at KP, which is cost of preference. So cost of preference shares is denoted by KP. And how do you calculate your cost of preference shares? Cost of preference shares is nothing but your dividend rate. Okay. So let's say the company has issued preference shares and the company says on my preference shares, I'll be giving you a dividend of 10%. So in that case, my cost of preference will become 10%. So that's my cost of preference. In case the company's preference shares are listed on the stock exchange and trading is happening, just like your equity shares get listed, some companies can also list their preference shares. Then in that case, how do you calculate your cost of preference? Cost of preference will be nothing but your dividend per share upon your market price per share. So let's say your dividend per share is 10 rupees, your market price per share is 200. Then in that case, your cost of preference will come as 5%. So in case the shares are not listed and traded, then I will directly take my dividend rate as my cost of preference. In case my shares are trading in the market, they're listed, then my cost of preference will be dividend per share upon market price per share. Any doubt with cost of preference or cost of equity or cost of debt? Any questions till here? Okay. So let's say you get your cost of equity as 20%. You get your cost of debt as 15%. Dividend is not mandatory. Fine. Dividend is not mandatory, which is equity dividend. Huh? Preference dividend you have to pay. So equity dividend is up to the company. Whether I want to give it to you or I don't want to give it to you, I'm fine. Preference dividend is like you enter into a contract saying that I'll pay you 10%, 15% preference dividend. So that's like interest. Okay. So let's say you've calculated your cost of equity, cost of debt, and your cost of preference. And let's say you get cost of equity as 20%, cost of preference as 18%, and cost of debt as 15%. So equity is the riskiest one. So their expectation will be highest. Debt has the lowest risk. So the expectation will be the lowest. Preference is a mix. It has features of both equity and debt. So it will be somewhere between cost of equity and cost of debt. And let's say you calculate and you get an answer of 18%. Once this is done, then you look at the value, which is in rupee terms. So let's say equity shareholders have pumped in 1,000 crores in your business. Lenders have pumped in 2,000 crores in your business. And let's say preference shareholders have pumped in 1,000 crores in your business. So can you calculate and tell me what will be your weighted average cost of capital? So weighted average cost of capital, I'll just write the formula for you. It will be the weight into the cost. So you take your cost of equity into the weight of equity. Take your cost of debt into the weight of debt. And take your cost of preference into the weight of preference. So calculate and tell me how much are you getting. %. Okay. Any other person who's got 17%? Or you're not getting the answer? 17. Fine. Anyone struggling, not getting 17%, let me know. I'll solve it. Yep. If you're getting 17, I'm fine. If you're not getting it, just let me know. Cool. 17% is the right answer. Because if I look at the weights, what are my weights? Out of 4,000 investment, equity is 100, which means my weight is 25%. Debt is how much? 50%. And preference is how much? 25%. So I know the weights, I know the cost, multiply them, add it up, you'll get your WACC 17%. Yeah. Any doubt, any query with weighted average cost of capital? And this cost of capital is what you use in your IRR. You compare your IRR with your cost of capital. This is what you use when you calculate your NPV, so on and so forth. So this is that cost of capital of 10%, 15%, which we are doing in today's class. Yeah. Any doubt, any query? Otherwise, we are done for the day. So that's your syllabus. Go through whatever we've done. Term and question format. I'm yet to make it, but then again, you will have, let's say, I think it's a 60-mark paper, right? If I'm not wrong. Yeah. So you will have 3 questions of 20 marks each. Of course, these questions could have subparts as A, B, C, D, or maybe one question of 20 marks where you could have a mix of theory and numerical. So you'll have 3 questions of 20 marks. Each question could have subparts. So let's say one part could be 10, other one could be 5, 5, or maybe 10, 2, 8, depending upon whatever permutation combination. But you'll have basically 3 questions of 20 marks, including theory and numericals. Excel will be allowed. So you can do questions on Excel. So let's say I tell you, I give you a few numbers and I tell you calculate MIRR, or I tell you to calculate IRR. You can use Excel and do it. That should not be an issue. So accordingly, instructions will be given to the exam department to allow Excel. So again, whatever we've done in the class, if you've understood that, that's that should be, good for you, because I don't expect you to become experts in finance as such. You are more inclined towards analytics. This is like an add-on subject where you should have basic knowledge of finance. So basic knowledge of finance, if you have it, that should be enough. So again, if you look at your async content, you'll have a lot of complex questions, let's say, where they would have probability and decision tree and all of that. Okay. So again, you can just go through that for the theory aspect. So, I'm not going to question you a lot saying that, okay, let's say depreciation is given in the question and how do you calculate, let's say, your cash flow, so on and so forth. Basic things like we discussed, let's say, how do you calculate cash flow? Cash flow is profit after tax plus depreciation, let's say minus capital expenditure plus terminal value, salvage value, and do your adjustments for your working capital. Basic questions, as long as you understand this, I'm fine with that. I don't want you to be an expert in finance, so don't worry about it. Yeah, anything else? Otherwise, we can end it. Okay, fine. Thanks. It was great teaching your batch. Thanks a lot. Bye. Take care.